Have you ever seen price explode in one direction and then suddenly coming back into the same area before continuing? Most traders think that that's just a random pullback, but a lot of the time, the market is just coming back to fill an imbalance. And if you understand that, you start seeing the chart very differently. So today, I want to break down one of the most important concepts in price delivery, and that is imbalance, or which is also known as inefficiency, which is also known as the fair value gap. Because when price moves very aggressive in one direction, it's going to leave behind an inefficiency in price in the market. And understanding that can help you anticipate where price may retrace, react, or continue from. In the first lesson, we talk about how the market have to move from phases of imbalance to balance to imbalance to balance again, right? Because the market is actively seeking fair value. That's what this concept is about, right? Imbalance is basically an inefficient area in price where one side was so aggressive that the market moved too quickly and did not trade efficiently through that zone. So it's basically an area where price moved so fast, so far, that it left behind unfinished business. Right, just like in this case right here, we have a bullish candlestick right here. Next thing you know, huge bullish candlestick signaling there's a lot of buying pressure, a lot of buying momentum, and then the momentum starts slowing down. Right, when this happens, this pretty much tells us that there is an imbalance right here, and this is the gap that smart money has left behind because they have pumped price up so fast, right, that it just didn't have any pause whatsoever. So a fair value gap, it's basically one of the most clearest visual forms of imbalance. It usually appears in like this three candlestick sequence just like this, where the first candlestick leave one side of the range, the second candle expand aggressively either to the upside or to the downside, and then the third candle leave a gap between the wick of candlestick number 1 and the wick of candlestick number 3, forming your fair value gap. Okay, so once again, let me just slow it down a little bit. Basically, when you see like a big bullish or bearish candlestick just like this, what you want to do is to find the first candlestick that was before that big juicy candlestick and the candlestick that came after that big juicy candlestick, and you find the low of the candlestick that comes after that and the high of the candlestick that comes before that, and you draw a box just like this, and this is where you got your fair value gap. And this gap shows you that price has moved very quickly through that area itself. So a bullish fair value gap, just like this, is a strong move to the upside, which leaves inefficiency below. A bearish fair value gap is a strong move to the downside that leaves inefficiency above. Okay, so once again, you must understand the logic behind the fair value gap. The reason why it formed in the first place is because there was such an aggressive amount of buying or selling pressure. And as a result, that caused price to expand very, very quickly. So this pretty much tells us that at this point of time, there's so many sellers in the market that there was so little buyers in the market, which caused price to just move very aggressively to the downside. Therefore, the market is counted as inefficient at this point of time. Okay, so when the market moves too aggressive just like this, it does not always price everything fairly on the way up or down. So as a result, it's just going to leave behind a gap which is known as our imbalance or inefficiency, also known as a fair value gap, right? So there's a lot of different names for it. Now, after this gap is formed, we are expecting the market to actually pull back to this gap. Now, why? Because remember, when we talk about how the market moved from phases of imbalance to balance to imbalance to balance because it's actively seeking fair value. So after a huge imbalance to the downside, we're expecting price to pull back to fair value, right? Going to the next phase, which is the balance phase, before the next phase of imbalance again, and then balance, and then imbalance, and balance, and balance. Because the market is often seeking efficiency, seeking fair value, right? So this revisit in price can act as like a retracement where price is potentially mitigating the fair value gap and then continuing to the downside. So yeah, that's the fair value gap. It's not just a gap, it is a clue that the market may want to rebalance before moving on. Right? So now, just follow these rules right here and you will be able to easily identify a fair value gap. Basically, you just want to see like a big juicy candlestick just like this, either a bullish or a bearish candlestick, which signal there is strong displacement. And then you want to look for the candlestick that comes before it and after it. If there is a gap that was formed at the high of the previous candle and the low of the following candle, and there's a gap just like this, then there is imbalance. However, if let's say, even though we see a big candlestick just like this, in the previous candlestick, the wick was like somewhere right around here, right? And then the next candlestick, the wick was somewhere around here. So in this case, once again, following the exact same principles, we identify a huge candlestick just like this, strong displacements. So somewhere over here, there might be a fair value gap or there might be an imbalance. Now let's take a look at the candlestick that comes before and after it. Well, the candlestick that came before it, the high was right here. Well, the candlestick that came after it, the low was right here, right? So if you look at this, there is no fair value gap whatsoever. So even though there was a lot of buying pressure and a lot of buying momentum here, there is actually no imbalance, right? This just showed that, smart money did actually came up there, pull back, fill up the remaining buy orders before continuing even further, right? So there is no imbalance, there is no inefficiency whatsoever. So ideally, we want to combine whatever we have learned so far with this concept itself, which means that we want to see a bullish fair value gap at a discount range. And ideally, we want to trade it if the higher time frame trend direction, the swing structure, the internal structure is actually bullish. Then we want to look for longs at all of this fair value gap when price comes down to mitigate it. Same thing as the bearish fair value gap, but like in the opposite manner. So now let's try to go onto the charts and try to apply this concept itself, right? Before I give you more tips on fair value gap. So just using your naked eyes alone, you should be able to easily spot the fair value gap. Like I said, first step, just look for strong displacement. Okay, let's go from left to right. Right, left side here, what do we have? We see big candlesticks just like this. Immediately, my eyes is drawn towards that big bearish candlestick, and this is where you can find the candle that came before it and the candle that came after it. And then this is where you can draw a box marking up the imbalance, marking up the gap just like this. And sure enough, later on price went up there, mitigate the fair value gap, and then come down. Okay, and then another very obvious one that I've seen is probably this one right here. Very obvious strong displacement, the low of previous candlestick and the high of the next candlestick, drag all the way up here. And once again, you can see price came all the way down here, right? And then went up there, mitigated before continuing down even further. So this is why you guys shouldn't be rushing into trades when price has already made its move, right? So in this case, price has already came all the way down here. You don't want to be entering for a sell right here. Because if you're entering for a sell right here, you are going to be at a huge disadvantage because you have to place your stop loss above this high and your entry is just not precise anymore. So you're much more better off being patient, because you understand the concept of imbalance and balance, just waiting for the market to pull back to a fair value gap just like this. And then when it does, then you look for shorts and then just continue shorting it down from there. So let's try to identify a bullish fair value gap. Since that's the bearish fair value gap, okay, there's one right here, right? Huge imbalance to the upside. Okay, there's a gap from this high and this low of the next candlestick right here. And sure enough, price pull back to this fair value gap, mitigate it, consolidate a little bit, and then starts going up. Now, let me just give you one final example before I can show you some tips and tricks. Maybe I can do it in the live market condition, right? So you can see this is very obvious, big bullish candlestick, strong displacement. And then this is the high of the previous candlestick, and this is the low of the previous candlestick. And you can see we got a little fair value gap right here. But in this case, the reason why the fair value gap failed is because if you look at the higher time frame structure, it is still bearish. So like I said, it's all about really just using as many weapons in the arsenal to just develop a proper trade bias, taking into consideration everything before you actually look for longs or look for shorts. So another thing that you guys must understand is that you want to make sure that you don't just mark up fair value gap if there is no gap whatsoever. What I mean by that is that a lot of people that they see like big candlesticks just like this, you can see big candlesticks, then they immediately come here and they try to like mark out a fair value gap as like this range right here or something. But that's not true, right? Because there is no gap whatsoever. If you zoom into this price point over here, okay, yes, strong displacement, but if you look at the high of the previous candlestick and look at the low of the next candlestick, which is right here, there is no gap whatsoever. And since there's no gap, this is not counted as a fair value gap, which also means that there is no imbalance right here. Okay, compared to if you look at the left-hand side over here, where did price actually retrace to? Price potentially retrace back to this fair value gap that we have right here. Okay, retrace back to this bearish fair value gap and then continuing with the higher time frame downtrend. So remember, you don't just want to look at fair value gaps alone. You want to think about what is the market doing right now, who is in control of price. Okay, so right now, clear as day, price is bearish right now, sellers are in control of price. Cool, that tells me that I need to look for bearish fair value gap. Okay, and then ideally, I want to wait for price to pull back to an imbalance to the downside. And then once that happens, then I can potentially look for shorts. Okay, or what you can do is also to combine your premium and discount with your fair value gap concepts. So example, in this case right here, price broke structural, came down. This is your swing high and this is your swing low. And then maybe I can just map that premium and discount up there. And this is where you might have identified one fair value gap right here, another fair value gap right here. And you can see both of these are fair value gaps. But why is it the fact that this one got disrespected, where price just blasted right through it, while this one actually got respected? It's because this one is more high up within the premium range. And there's also a more bigger amount of imbalance right here, where the market has to feel before it continue going down even further. So yeah, always make sure that you trade fair value gaps with context. Once again, none of these market mechanics concept, they can work just by itself alone. You cannot just say, okay, bearish fair value gap, I'm just going to enter for a sell. Bullish fair value gap, I'm just going to enter for a buy. If you trade that way, it's very, very dangerous, right? You want to use multiple confluences itself. Another thing you must understand is that sometimes price will tap into the edge of the fair value gap and then react from it and then go. But sometimes it might go deeper into it. Okay, let me just give you a few examples. In this case, price came down, tap into the fair value gap, and then go. All right. And then in this other scenario, it came all the way up to the midpoint, which is the 50% of the fair value gap, and then go. Or another example is this one, right? Maybe price came all the way down here, came all the way up to the extreme, right? Extreme of the fair value gap, and then go. Or another example, like maybe this one right here, where price even pierced past the fair value gap and then go. So do not expect the market to react the same way every time. Just draw the fair value gap right there and don't assume that price is going to touch it and go. Okay, because there's sometimes where it will touch the 50% of it. There's also times where it will touch the extreme of it and then go. There's also times where price might break past the fair value gap, swap some liquidity, and then go. Okay, so never ever assume. Just use this as like a reference point, but like don't stick to it. Okay, like don't just expect or anticipate price to touch it and go. So once again, you want to make sure that you are using this fair value gap with the other concepts, supply and demand zones, with premium and discount. So ideally, I want to look for bearish fair value gap that is within premium pricing. I want to short from there. And I want to look for longs at the fair value gap, the bullish fair value gap that is within the discount range itself. And one way they can use fair value gap is that you can use it as a way for you to actually enter on your trade, right? So for example, the minute price mitigate this bearish fair value gap, you can look for shorts and then short it all the way down here. Another way you can use fair value gap is to use them as targets, because that is where price is gravitating towards. So for example, if let's say like I want to enter for a sell at this fair value gap right here, and then I want to target maybe this next fair value gap that we have on the left hand side over here. Okay, This is where you can potentially look for shorts. The minute price mitigate this bearish fair value gap, and you can potentially target the next fair value gap, which is where price is gravitating towards next, which is this one right here, right? This is the next bullish fair value gap. Yeah, so you can either use it to help you enter your trades, or you can also use it to help you to set your take profit. Because once again, you must understand that that is just the price point in which price is gravitating toward. It doesn't always have to fill up the fair value gap, but a lot of times it tends to do that before continuing moving off. So maybe let me just go through like a few more examples, or maybe I can show you how I will use it live as well, right? So let's just look at this one right here. Okay, so in this case, let's say price has been coming down here very aggressively, okay? Very aggressively coming down. You look at the internal structure, you saw that prices came down, pull back, and then goes down even further, creating like an internal break of structure to the downside, just like this. Okay, so this becomes my swing high, and then this becomes my swing low. Well, my swing low has not been formed yet since price has not made a pullback, right? So let's just wait. Okay, the minute price starts pulling back, then I can move my swing low here. So now, once again, just using all the concepts that we have learned so far, this is where you can map out your premium and discount. Okay, and right now we are anticipating price to pull back to the premium range before continuing down even further. It doesn't have to, but if it does, good for us. It's just an additional confluence. But like I said, it doesn't have to. And then maybe I can draw my supply zone, right? Just by marking up this pivot candle right here at this extreme end, right there we have supply zone. Okay, and then now introducing this new concept of imbalance or fair value gap, I'm asking myself, okay, where is the strong displacement in this entire move? Because once I identify the strong displacement, which is really just a fancy word of a big bullish or bearish candlestick, then I can identify my fair value gap, right? So in this case, once again, I'll say like just use your naked eyes and just compare it with the size of the candlesticks that is near it, right? So that's how you kind of tell whether it's big or small. You just find like, use your common sense and try to find like the biggest candlesticks in here, and then just try to compare it with like the preceding candlesticks, right? If it's way bigger than them, right? If it's like a big boy, then you know that that's probably a strong displacement. So in this case, big candlestick right here, okay? Then now I'm looking at a candlestick that comes before it and a candlestick that comes after it. So for the candlestick that comes before it, this is where I mark up the low. And then for the candlestick that came after it, that's where I mark up the high. So now, is there a gap? Yes, there is, right? There is a gap which tells us that there's an imbalance or inefficiency or fair value gap or whatever name you like to call it. So this tells us that price is going to be gravitating towards that gap, fill up that gap before continuing down even further, right? So in this case, this becomes my fair value gap right there. Okay, so that is the most recent bearish fair value gap. Now, is there any other fair value gap right here? Well, let's look at the candlesticks, right? Is there a fair value gap, say, around here? Nope, because this low is around the same level as this high right here. Is there a fair value gap around here? Well, this is the low of the previous candlestick, this is the high, so nope, no gap. So no gap, no gap, no gap, only here have a gap. Okay, so this is like the only fair value gap inside this entire move to the downside itself. And just observe what price does next. Okay, price pretty much came up there, mitigates the fair value gap, and then continuing down even further. And I believe it's going to start reversing anytime right now. Oops, that's a little bit too fast. Okay, but it ends up consolidating around here and then eventually reverse. Okay, so if you were to trade this fair value gap, right, you can potentially look for shorts. The minute price mitigate this fair value gap, place a stop loss above the fair value gap, and just target like 3R or 2.5R. You know, we're going to talk more about where to place a stop loss and where to place a take profit later on. But for now, not going to focus on entries and exits, just going to focus on sharing with you guys like this fair value gap concept and just helping you guys implement it. So yeah, in this case, right, this could have potentially worked out. And where would you have been able to target? Well, you know, another way that you can use fair value gap is to use it as a price point to actually target, right? So in this case, maybe let's come back here. So let's say you got tapped into the trade right here, you enter for shorts, you know, and you place a stop loss above the fair value gap, and now you don't know where to actually target. Okay, so what you can potentially do is to find where's the next opposing fair value gap. So if I'm entering for a sell at a bearish fair value gap, I want to target the next bullish fair value gap, because that's where I'm expecting price to move towards next and then reverse to the upside. So this is where I'm looking at the left hand side, looking at the price action that just happened right here, and I'm asking myself, where is the most recent bullish fair value gap? Because that's potentially where I can set my take profit. So I'm looking at the left hand side right here. What happened was that price went up, right? Strong displacement to the upside, cool. Let's go step by step. Big candlestick right here, and then followed by another candlestick, and then followed by another bigger candlestick itself. So just by doing this alone, I can map this as a fair value gap, because this high right here and then this low of the next candlestick was formed, leaving us like a fair value gap just like this. And then there could potentially be another fair value gap right here, right from this previous high and to this new low right here. So there's actually two fair value gaps in this case. And if you go down to the 5-minute time frame, you will see that price actually end up coming down to the second one, respecting the second one, maybe coming even deeper into what we would call an order block over here, which you're going to learn in the next lesson, and then starts moving to the upside, right? So I would say like what you can do is to use it either to enter on a retracement, right? Use it to like allow yourself to gauge where price is retracing to, or you can also use it as a target area, because that's where price is most likely going to move towards next in order to rebalance. Obviously, like if you were to place a take profit at this fair value gap, it's not the best like risk to reward decision unless you're scalping. You know, if you're scalping, you could potentially enter like upon the mitigation of this fair value gap, stop loss above that high, and then just target like this low right here. But like I said, I don't want to get too deep into the nitty-gritty details when it comes to entering and exiting, because I really want you to like just familiarize yourself with this concept of fair value gap itself. Because like I said, it's a very simple concept, but if applied well, it's actually pretty powerful. Now, I can't emphasize this enough, but just because you can identify that fair value gap does not necessarily mean that it's going to hold. Remember, the whole gist of a fair value gap is that that's where price is going to move towards next. But it doesn't tell you that, okay, that's where price is going to move towards next and it's going to hold. No. It just says that it's a magnet that's drawing the price towards that area. Whether that area holds or not, that's another story. That depends on the market structure, depends on whether there was liquidity, depends on so many different other factors. So that's why you don't ever want to assume that the fair value gap is going to hold. This is the mistake that a lot of people make. They just trade fair value gaps alone, right? When price mitigate the fair value gap, they immediately enter for the trade without realizing that, you know, it's not going to hold because the structure is against you. You are trading at the wrong location. You are trading a bullish fair value gap in a premium pricing. You know, like you don't take into account the context of the market. And as a result, you fail trading that fair value gap. So just to give you an example of what I mean by that, look at this. Strong move to the upside, right? Strong move to the upside. Very strong displacement right here. Big bullish candlestick. A lot of buying pressure. A lot of buying intent. A lot of buying momentum. So just by looking at this alone, I can see that, okay, this is the high. This is the low. Boom. My fair value gap is right there. And in this case, price has pretty much come down, right? It's retracing. At this point of time, your immediate instinct should be, okay, price is retracing. Now, where is price most likely going to retrace towards next? The fair value gap. That's it. Okay, that's what you use fair value gaps for you to know where price is most likely going to retrace to, because that's the area where price needs to balance before you continue moving. So in this case, I'm not going to be entering for a buy right here. I'm not going to be entering for a buy right here. I'm only going to enter for a buy if price has came back down to my fair value gap, and that is where the balance can potentially occur. Right? So in this case, price comes down to the fair value gap. Now I will consider looking for longs if I have multiple confluences. right? If I have multiple confluences that telling me that it's a good idea to enter for longs, then boom, this is where I can enter for longs. If not, then I would just be using this as a reference point for me to know where price is moving towards next. And that's it. I will not trade it. So in this case, let's continue to see what price does. Price came down and break right through it. Like I said, it's not just about the fair value gap alone. It's about a myriad other different factors for you to actually develop a great trade idea. So yeah, I hope I've shown you guys like multiple examples, right? Just to really ensure that, you know, you are super duper familiar with like just applying this concept and just knowing that it's not as simple as, oh, buy at a fair value gap, a bullish fair value gap, or sell at a bearish fair value gap. You need to take into account of the liquidity, the market structure, the zones around it, right? A lot of different other factors which we are going to continue talking about over the next few lessons itself. So to keep it simple, just to sum up everything, an imbalance or a fair value gap is an inefficient area in the market that is created when the price moves very aggressively in one direction. Basically, in simple English, it just tells us that at this point in time, smart money have entered for a large amount of buy orders, causing price to move up so aggressively that it just created this gap, just left behind this gap. Same thing for the bearish fair value gap, but instead of buy orders, they entered for a shit ton of sell orders, causing price to collapse so fast, so far that it left behind a gap just like this. And remember when we talk about the supply and demand concept, where we talk that when smart money push price in a certain direction, it tends to cause price to retrace back to that same direction so that they can fill up the remaining orders. It could be the same thing in this case right here. After a bullish fair value gap just like this, smart money might want to cause price to come back down to this fair value gap and then look for more buy orders, causing price to continue going up. Okay, so that's the concept of fair value gap. It's very simple. It's basically huge move, and we are expecting price to retrace to fill up that huge move and then going up even further. Just tying back to the cycle of imbalance, balance, imbalance, and then balance, and then imbalance again. That's just the wheel of price, right? That's just how price fundamentally move. But like everything else in trading, it's not just about identifying and trading the fair value gap. It's about learning how to use it in the right market conditions, learning how to combine it with other confluences to develop a proper trade idea. That's what the fair value gap is. And in the next lesson, or I don't know, like the next few lessons, I'm going to talk about an order block, which is a concept which requires you to really understand imbalance or fair value gap. If you don't understand whatever I just covered for like the past 30 minutes or so, please make sure you rewatch it, right? Rewatch it over and over again until you get it. And not only must you get it, but you must also know how to implement it. If you know how to implement it, then you can move on to the next lesson. If you don't, then I'll say like keep on practicing, keep on like training your brain to like spot this fair value gap and spot these imbalances. And most importantly, please just watch these lessons in chronological order, right? Because if you skip this lesson and you move on to the order block lesson, you won't know anything that I'm talking about on the order block, because like each lesson is built on top of the previous lesson itself, right? So if you want to learn how to trade order block, you have to first learn how to identify imbalance, because you can only find an order block when you have identified imbalance. Right, so all of these concepts literally built on top of each other like a pyramid. And if you just skip to the next level, for going the previous level, it's like going to fight the level 100 boss in a video game when you haven't even defeated the level 20 boss. Right, so stop trying to rush the process, continue plowing through these courses and lessons in chronological order, continue getting better at understanding these concepts and just applying them. Okay, so maybe I'll just give you one last example to end off this video itself, right? Just to show you like how it really works once again, because I just really want to emphasize the importance of this concept itself. So price came down very aggressively, strong displacement in price. Okay, immediately spot the strong displacement. When you do that, this is where you can look at the candle that came before it and the candle that came after it. And when you do, find the low of the previous candle, find the high of the next candle if it's a bearish fair value gap, and drag it out just like this. And boom, that is your fair value gap. And in this case, price came up, mitigate the fair value gap, continue going down, but there was not enough liquidity, there was not enough fuel. So as a result, it actually came back up and mitigate the order block, which is what we're going to cover next, and then continuing down even further. Right, so hopefully by now you have seen like how important it is to like just really have multiple weapons in your arsenal so that you can like maneuver and change to a different position when your enemy is fighting from in the other direction. That's what trading is really about, right? It's just really about having as much confluences as possible to make the most sense out of the market so that you can have the probabilities on your side, right? So that you can have the odds on your side rather than having them stacked against you. With that said, I look forward to teaching you guys a new concept in the next lesson. And as always, remember, you're just one trade away. Mwah.